Hey everyone, and welcome to the Deep Dive. Today we're really digging into some sources that unpack some fascinating, maybe even a bit puzzling forces shaping our economy right now.
That's right.
Our mission, like always, is to cut through the noise, unravel why things like long-term bond rates are acting so weirdly, look at market psychology, and even the huge global game around computer chips.
Yeah, and you might think, this is just for finance nerds, but honestly, this stuff, it connects directly to your wallet, your future, really the world we're living in.
Exactly. So let's jump right in.
Okay, so we're looking at three big things today. They seem complex, maybe, at first glance, but we're going to break them down, make them make sense, hopefully give you a few of those aha moments along the way.
All right, let's tackle this first big puzzle.
Yeah.
Why are these really long-term interest rates? We're talking 30-year U.S. Treasury bonds. Why are they so high right now? The news might say government spending, but our sources point somewhere else.
Yeah, it's really interesting because while government debt, it always plays a role in interest rates, the main reason for these high 30-year rates today isn't just like worries about deficits or trust in the government paying its bills.
Okay.
Our sources are really zeroing in on two things. One, regulatory changes, and two, something called an ALM mismatch. That's asset liability management happening inside big financial institutions.
ALM mismatch.
Right. It's less about a crisis of confidence, more of a structural thing, a supply-demand distortion right in the market.
Okay, so rates are high. Normally you'd think buyers would be lining up for that yield, but they're not. Who usually buys these things and what changed?
Exactly. So traditionally, the big end buyers, the ones who hold these bonds for the long haul, are huge players like insurance companies and pension funds.
Makes sense. They have long payouts.
Precisely. Think about it paying out pensions, insurance claims like decades from now. So holding a 30-year bond, getting that steady interest payment, it was a perfect match for those long-term promises, those liabilities.
But something's different now.
Yeah, the twist is new rules. Specifically, mark-to-market accounting rules. They've really changed the game for these guys.
Mark to market.
Yeah.
How does that work here?
Well, think of it like this. In the old days, buying that 30-year bond, it was kind of like owning a building that just reliably churns out monthly rent. You just record that rent, the interest, nice and steady.
Okay, simple enough.
Now, with mark-to-market, it's more like owning an apartment, but its value swings wildly every single day with the housing market. So if interest rates go up even a little bit, say 0.5%,
Uh-huh.
the price of that 30-year bond can plummet, like 10% easily. And under the new rules, that loss, it shows up immediately on their balance sheet.
Ouch. So managers hate that volatility.
They really do. It makes them super wary of holding these things when rates are climbing because it messes with their capital numbers instantly.
Okay, that analogy helps a lot. So let's unpack that ALM mismatch term. Sounds technical, but how does it actually make these big buyers behave differently, especially with these new rules?
All right, let's break it down. Basically, these insurance companies, these pension funds, the assets they hold, like bonds, tend to have, say, an average life or duration of around 10 years.
Okay, shorter term than 30 years.
Much shorter. But their liabilities, the money they owe people way down the line, that stretches out 30, maybe 40 years. So you've got this gap, right? A duration gap. Their assets come due way faster than their promises.
Got it. Assets short, liabilities long.
Exactly. And that gap makes their financial health really sensitive to interest rate swings. Here's the weird part.
Okay.
When interest rates go up, the value of their bonds, their assets, it falls. That's a loss. But the value of their longer liabilities falls even more.
Wait, so higher rates actually help their capital position?
Counterintuitively, yes, it improves their capital ratio. So in that situation, when rates are high or rising, there's actually no pressure, maybe even zero incentive for them to buy more of those volatile 30-year bonds. Their books actually look better.
Huh. Okay, so what happens when rates fall?
That's the flip side. When interest rates fall, the value of their bonds, their assets, goes up. Sounds good, right?
Seems like it.
But the problem is, the value of their super long liabilities, it shoots up by even more. And that erodes their capital. It makes their financial cushion look smaller.
Okay, so that's when they need the long bonds.
Precisely. To plug that gap, to shore up their capital, they are forced to aggressively buy long-term bonds when rates are falling. So, the big takeaway, these crucial buyers, they really only jump into the market in a big way when rates are falling, which leaves a huge demand vacuum when rates are going up.
Wow. Okay, so that's the distortion.
Yeah.
What does this strange behavior mean for the wider bond market and, the rest of us watching the economy?
Well, it creates this significant market distortion, like you said. If those big N buyers aren't reliably there when rates are high,
Yeah.
then the intermediate players, traders, hedge funds, they get hesitant too. Why buy something if you're not sure you can sell it later to the ultimate holder?
Right, the hot potato problem.
Kind of. Our sources even mention Japan, where auctions for their super long bonds sometimes have really low participation. Same basic issue, different country.
So for someone thinking about investing,
For you, it means that common idea, oh, rates are high, great time to lock in a good coupon on a long-term bond. It's incomplete.
how so?
Because investing in long-term bonds, especially these days, is often really a bet on rates falling. You're hoping to sell the bond later for a capital gain when its price goes up.
Ah, not just collecting the interest.
Exactly. But if that end buyer isn't there consistently to provide the demand when rates are high, that whole strategy gets riskier. It breaks down a bit.
So what's the outlook? Are we stuck like this?
Well, some experts we looked at are pointing towards maybe early to mid-2026 as a potential turning point.
Okay, why then?
The thinking is, if interest rates finally peak and start heading down, then these big institutions, the insurance companies and pension funds, they'll be forced back into the market. They'll have to buy long-term bonds aggressively to fix their ALM mismatch.
And that would push yields down.
Could cause a sharp drop in yields, yeah. And maybe even more volatility. So this isn't just some obscure corner of the market. It affects borrowing costs for everyone, companies, governments, even mortgage rates eventually. It touches the stability of the whole financial system.
That whole dynamic, how these rules and institutional needs create these weird market effects, it almost feels like the market has a mind of its own. Does this connect to that idea from George Soros, reflexivity?
Oh, absolutely. It's a perfect example, actually. Soros's idea of reflexivity really challenges that old textbook view that markets just, process information and find some natural balance.
Right, the efficient market idea.
Exactly. Soros argued that prices don't just reflect reality, they actively shaped it. Reflexivity is this feedback loop, a self-reinforcing loop between what people believe about the market, their perceptions, their theories, and what's actually happening, the prices, the fundamentals.
Okay, a feedback loop. How does that work?
So think of it like this. What people believe influences how they act. Right.
Yeah.
Their actions then change the market itself, maybe push prices up or down, and those changes in the market then feed back and change what people believe. It's like this continuous conversation where thinking affects reality and reality affects thinking.
Beliefs shape actions.
Yeah.
Actions shape reality. Reality shapes beliefs. Round and round.
You got it. Soros talked about the cognitive function, how we understand the world, and the manipulative function, how our actions based on that understanding actually change the world, like changing bond prices or credit availability.
So how does that reflexive loop show up in the bond market weirdness we were just talking about? Can we see it in action?
Definitely. You can see it working in both directions, negative and positive cycles. Let's take a negative loop. Imagine bond demand starts to dip, maybe just a little bit, some initial worry perhaps,
Okay.
Prices fall, rates go up. But then higher rates make borrowing more expensive for companies and governments. Their finances look shakier.
Which worries investors more?
Exactly. It spooks them further. So they pull back even more. Maybe they're even forced to sell because of risk rules or margin calls.
Ah, forced selling.
Right.
Yeah.
That pushes rates even higher, which makes finances look worse, which forces more selling. Downward spiral. The 2022 UK LDI crisis, our sources mentioned. Classic reflexivity. Rising rates triggered calls for more cash.
Collateral calls.
Yeah, collateral calls, forcing pension funds to sell bonds, which pushed rates higher, triggering more calls. A painful loop.
Okay, so that's the bad loop. What about a good one?
It works the other way, too. A positive self-reinforcing loop. Let's say bond demand picks up, maybe some good economic news, maybe signs inflation is cooling.
So prices rise, rates fall.
Right. Lower rates make it easier for everyone to borrow, their finances look better, investor confidence improves, more money flows into bonds.
Pushing rates even lower.
Exactly. And remember those ALM investors we talked about? When rates fall, they're forced to buy long bonds. That automatic buying adds fuel to the fire, pushing rates down further still. It feeds on itself.
What makes these loops get so strong? And what stops them? Can they just go on forever?
Good questions. Several things can amplify them. Regulations and risk management rules are a big one. Things like value at risk limits, VARA limits can force selling when prices fall, making a bad loop worse.
Like dominoes.
Kinda. Or, on the upside, less stress might allow firms to take on more risk, amplifying a positive loop. Then you have institutional investor rules. The automatic buying and selling by pension funds trying to match durations, or index funds just rebalancing that, creates self-reinforcing behavior too.
Policy matters too, right?
Hugely. Policy signals. What the Fed says it might do, government spending plans. That directly shapes expectations, which shapes reality. And simple supply shocks, like a giant new bond issuance, can kickstart a loop.
But they do stop eventually.
Oh yeah, they don't go on forever. Breaks include basic valuation limits if rates get ridiculously high. Bargain hunters eventually step in. Policy intervention is key, central banks providing liquidity, governments adjusting borrowing plans, or just some exogenous shock, something unexpected from outside the system, like inflation suddenly disappearing or a major event that just resets everyone's beliefs.
So thinking about this reflexivity idea,
Mm-hmm.
what does it really tell us if markets aren't just rational calculators?
Well, it tells us why markets can get so extreme, right? Why sentiment, psychology, herd behavior matters so much. It helps explain why sometimes, if enough people believe something will happen, their actions make it happen. For a while, anyway.
Until the feedback loop breaks?
Until the loop breaks or reverses. It's a really powerful way to look at any system where human beliefs and actions interact with outcomes, not just finance. Helps you question assumptions.
Okay, let's shift gears now. From those maybe more abstract market forces to something very physical but just as critical. The global semiconductor industry, computer chips, the brains and everything. Our sources show this area is going through a massive geopolitical upheaval.
Yeah, it really is. And if you think about the big picture, for decades, the whole semiconductor supply chain was obsessed with one thing. Efficiency first. We called it just in time.
Get it made cheap, get it made fast.
Pretty much. Production got super concentrated in a few places, mostly Asia, because that was the cheapest way to do it. But now, everything's changed.
What changed it?
A few big things hitting at once. Intense U.S.-China rivalry, for sure. Then the pandemic showed everyone how fragile those long supply chains were. Add in geopolitical stuff like the war in Ukraine.
Right, disruptions everywhere.
Exactly. So the whole mindset has flipped. Now it's resilience first, or maybe just in case. Countries like the U.S., Europe, Japan, they're now treating chips as a strategic national security asset.
Not just a component anymore.
Not at all. So they're pushing hard, pouring money into building domestic production, diversifying where they get chips from.
So for you listening at home, this basically means the whole map of where your next phone chip or computer processor comes from is being redrawn. And it's not just about cost anymore.
Not by a long shot. It's about ensuring supply almost at any cost, which down the line could definitely impact device prices and availability.
Okay, so let's talk about the giant in the room.
Yeah.
TSMC in Taiwan, world leader. They're building new factories, fabs overseas now. How does that fit this resilience picture? What are the trade-offs?
Right. TSMC is definitely expanding. They're building huge new facilities in places like Arizona here in the U.S., Kumamoto in Japan, Dresden in Germany. It's a direct response to this push for resilience.
But it's not easy, right?
Not at all. Our sources highlight some big challenges. Take Arizona. Costs there are sky high, like 4 or 5 times more expensive for labor and construction than back in Taiwan. Plus, finding enough workers with the very specific skills needed, that's tough. And there are always background worries about protecting their secret sauce, their intellectual property. Politically, too, there's even talk in Congress about potential U.S. first rules that could force TSMC to prioritize American orders in a crisis.
What about Japan and Germany?
In Japan, they're getting massive government subsidies, billions of dollars, and partnering with big Japanese companies like Sony and Toyota. This helps Japan rebuild its own strength in chip-making materials and equipment, which they used to dominate. But Japan has its own headaches, shrinking workforce, rising energy costs.
And Germany.
Germany is part of the EU's big push for technological sovereignty. But again, different labor laws, regulations, it all adds complexity and cost compared to their home base.
So it sounds like TSMC is doing this because they have to, not because it's necessarily the best business decision?
That's a fair way to put it. Even TSMC's legendary founder, Morris Chang, has basically said their real competitive edge comes from having everything concentrated in Taiwan. The talent, the suppliers, the whole ecosystem working together. He implied these overseas fabs are just inherently less efficient.
So diversifying helps manage geopolitical risk, but it might hurt their bottom line and maybe even slow down innovation a bit.
That's the tightrope they're walking. It's a strategic hedge absolutely necessary in today's world, but it comes with real trade-offs in efficiency and maybe even their technological lead over time.
Okay, stepping back from just building
Yeah.
fabs, what are those big geopolitical risks driving all this? What are the choke points that keep leaders up at night?
Yeah, beyond just where the factories are, you have to look at materials and politics. A huge one is China's dominance in strategic minerals.
Stuff needed to make chips.
And lots of other tech, yeah. China produces the majority, like 30 out of 44 key minerals, think germanium, graphite, rare earths. And critically, they refine something like 90% of them globally.
So they control the processing.
Exactly, and they've shown they're willing to use that control as a political weapon. Remember the Senkaku Islands dispute with Japan back in 2010? They restricted rare earth exports. That threat hangs over everyone reliant on those supply chains, US, Europe, Japan.
Okay, China's mineral leverage. What else?
Then there are Taiwan's own internal risks. Forget geopolitics for a second. Taiwan has earthquakes, potential power shortages, water scarcity issues, all things that could disrupt production.
Natural vulnerabilities.
And then add the geopolitical risk. Any serious military move or blockade in the Taiwan Strait, that's a global supply chain catastrophe overnight. And ironically, as TSMC builds fabs elsewhere, some argue it might weaken Taiwan's own leverage, its silicon shield, because the world becomes slightly less dependent on chips made only there.
Double-edged sword. Any other vulnerabilities?
One more key one highlighted in our sources, South Korea's HBM vulnerability. Korea, with giants like SK Hynix and Samsung, they lead the world in high bandwidth memory HBM. Super important for AI chips.
Yeah, you hear about HBM all the time now.
But here's the catch. They rely heavily on Japan for critical materials and equipment needed to make that HBM, things like underfill materials, photoresist, specialized wafers. There's this industrial DNA difference. Korea focused on speed and mass production. Japan focused on deep niche, long-term material science. That reliance creates a persistent supply chain risk for Korea's AI chip leadership.
Wow, so many interconnected risks. Is anyone finding opportunities in all this chaos, or is it just about managing the threats?
Oh, there are definitely opportunities. This intense competition is actually driving a lot of innovation. The U.S., for example, is playing to its strengths in AI design and software. They're tightening export controls on advanced chips going to China, yes, but also exploring more pragmatic approaches, like maybe allowing some sales if a cut goes back to the U.S. government, trying to balance security and economics.
Interesting. What about Taiwan? Are they just doubling down on chips?
Not entirely. While chips remain central, Taiwan is also smartly looking ahead. They're strategically cultivating the robotics industry as their next big growth engine.
Robotic.
Yeah, aiming for huge production growth by 2030. They see a way to leverage their semiconductor know-how, precision manufacturing, AI integration into things like collaborative robots for factories, advanced AI vision systems. It's about moving up the value chain and diversifying beyond pure chip making.
Smart. So bringing it all together,
Yeah.
what's the bottom line for us as consumers, as citizens, watching this global chip game unfold?
For you, I think the key takeaway is that this huge shift from prioritizing pure efficiency to demanding resilience, it has real consequences. It means the price tag on your next gadget, how quickly new tech arrives, even the overall stability of the global economy. It's all tangled up in these complex geopolitical moves and supply chain shifts.
Yeah, it's not just about companies anymore.
Not at all. Governments everywhere, the U.S. trying to reshore, the EU seeking tech sovereignty, Japan rebuilding its material strength, China pushing for self-sufficiency. They're all playing this high-stakes game. It's fundamentally about national security, economic power, and who controls the future of technology. It's much bigger than just chips.
Wow. Okay, that was quite a journey today. We've covered a lot of ground, from the strange world of 30-year bond yields
Yeah, the ALM mismatch.
to Soros' idea of reflexivity
Yeah.
and how market psychology can create these intense feedback loops.
Positive and negative ones.
And finally, this high-stakes global chessboard for semiconductor dominance, moving from efficiency to resilience.
Absolutely. And these topics, they might sound academic or distant, right? But they really do connect to everything. The stability of banks, how much it costs our government to borrow money, the price of your phone, the tech race between nations. It's all linked.
Understanding these hidden mechanics, the why behind the headlines, hopefully helps you connect those dots.
Exactly. Helps you see the bigger patterns, make a bit more sense of the, constant flood of economic news.
And that really is our goal here at the Deep Dive, just trying to equip you with that knowledge, that context, so you can see the world a little more clearly. So maybe here's a final thought to leave you with. If markets, and maybe other systems too, are truly reflexive, like Soros suggested, If our beliefs and actions don't just reflect reality but actively shape it, what does that imply about the power of our collective beliefs and actions in everyday life? Way beyond just finance.
That's a deep one.
Something to chew on, think about it, and we'll catch you on the next deep dive.